Carvana shares driving higher today. The stock surging nearly 30% at one point after the used car retailer put out early guidance and a plan to restructure its $9 billion debt. Karen's been digging in on the details of this one. She's got the fine print. Karen, what'd you find?
Yeah, so this was sort of interesting. I mean, it was good. It sounded like they're going to lose money less quickly, I guess. So the street loved that. But then they announced this exchange offer. We all know they have way too much debt. And this exchange offer is you're not getting money for your bonds. You're getting new bonds. And these are called cash pick toggle, which means they can either pay in cash interest, 9% in this case, or they can pay you pay in kind, meaning we're not going to give you any cash interest. We're going to give you additional bonds of these bonds as a dividend at a 12% rate. Sounds good, right? Yeah. And then we can toggle, meaning we can go back and forth between cash or this pick part, depending on how much cash we have. However, the good part about it is they said, we're going to pay you a value of 80 cents on the dollar. Now, that's a discount to par, but these things are nowhere near par. So let's look at several tranches of Carvana bonds. So I can't tell. Do we have one that went up a lot? No. OK. There we go. The one that went up a lot. This is like when you're at an airport and they say, we're going to board in groups. And whoever boards first, they get the overhead luggage space.
Right.
This is what they're saying here. We're going to board. You're going to get this exchange offer in groups. The 2025 debt that's due first, you get the first shot at it.
That's a great metaphor, by the way.
Really
I can see the scramble
right.
for the overhead.
So they're scrambling. There they are. They're positioning themselves, you know, boxing out Group 2. They're in Group 1. $500 million of Group 1 bonds. So that's why they're up so much. The other ones are like, we're gonna get crap. We're not, I mean, maybe we'll get a little bit off in the exchange offer, but not really. And then we're left with this still very indebted company. They've paid a little out the door already. This is no good. You can understand why Paulo and PIMCO are not happy with this. It just seems to be trying to push off bankruptcy.
When I was in, Tim and I went to college together. There was a class I took called Management Science.
Oh, MIS.
Which was a brutal class, and I wasn't prepared for a test. So I went into Professor Iglarsh, and I gave him a menu of reasons why and things that maybe I could do. That sounds like what these Carvana people are doing. They're throwing all this stuff against the wall, hoping that something sticks. It didn't work out all that well for me in Management Science on an exam, and I guarantee it's not going to work out all that well for Carvana shareholders. Just my opinion.
No, I'm sure it didn't work for you, and that probably wasn't the only class.
Yeah,
but extending, and you know, Carvana's got a series of debt instruments that, but the point is extending near-term maturities, and that's really all they're thinking about.
And they're just praying for, hoping for time.
And if you, they also pre-announced, and they actually had something relatively good to say, which is that, you know, they burned between 50 and 100 million versus 295 last quarter. So, you know, this is part of that story there, but it's not what I'm chasing.
I want to see at the end of the quarter, this current quarter, with more vending machines than they did, which is what they did the last quarter, which just boggles my mind.